Gold's not a rate of return investment. Gold is a wealth preservation asset. It took something like 2.5 times more gold to buy a house in 1970 than it does right now.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Dave Kranzler from Investment Research Dynamics joins us today. Dave has over 30 years of experience researching and investing in the precious metals markets, and Dave has also worked on Wall Street as a junk bond trader. His Mining Stocks Journal and Short Sellers Journal are two of the go to subscriptions for investors in the mining sector and equities. And we're delighted to have Dave Kranzler join us here today. It's time to saddle up and silver up for Dave Kranzler. Dave, welcome back to SBTV. How are you doing?
Doing well, Patrick. Thanks for having me on again. It's good to be here.
Glad to have you back on. Good to see you again. Yeah, Dave, I want to start with a recent tweet you put out referring to an article talking about Starwood Capital, which holds thousands of residential properties. And you tweeted, shortage of used homes? This is just the breeze ahead of the gale force winds of rental portfolio unloading. Wait till the ma and pa Airbnb owners are forced to sell. So, Dave, could you tell us what kind of an outlook are you seeing with real estate?
I mean, first of all, the idea that there's a shortage of homes of so I call existing homes used homes, in contrast with new homes that are built by home builders. Um, and there's a narrative out there, but it's propaganda that there's a shortage of housing. Now, I will say, the average cost of a new home, which is coming down quickly when you include incentives now, is higher than the cost of a used home. And I will say that, if you qualified it by saying there's a shortage of affordable homes for people who would like to own a home, then that would probably be a correct statement. However, I would also argue the flip side to that is there's a shortage of people who might want to own a home who are renting who otherwise cannot afford to buy a home. And the affordability of a home for the average household is, and I don't know how far it goes back, but I mean, it's right now is a period of I think it's one of the most periods of unaffordability for homes in at any time in post World War United States, so World War II United States. So, what I so Starwood, I think the portfolio of rental homes that he's unloading is 4,000. Was it a 4,000 home portfolio, something like that? There's a lot of corporate landlords who bought up huge tracts of homes over the last several years with the intent to rent them out. And there's actually some home builders have programs where they'll build homes and sell them to corporate buyers who then turn around and turn them into rental homes. And my contention is that at some point, you're going to see a lot of these rental homes that go unrented or are no longer economic with current interest rate environment and the cost of maintaining these properties. You're going to see a lot of these corporate housing portfolios get unloaded onto the market. And the guy who runs Starwood, Barry Sternlicht, I mean, not necessarily the most popular guy out there in the financial world, but he's a shrewd real estate investor, and he's uh, usually buys early and maybe sells a little early. But to me, the fact that he's starting to unload some of his rental property portfolios, tells me that he sees very tough times ahead for the rental market. And so, a lot of these rental homes, and we'll see the same thing with mom and pop investors and also Airbnb investors. I mean, there's reports all over cyberspace about in many areas, not all areas of the country, but Airbnb owners, rental owners, complaining about, it's hard to attract uh, tenants right now, or vacation tenants or whatever. So, one thing you have to realize is a lot of the bulk of these investment properties that were purchased, say in the last 3 or 4 years, were purchased using very low mortgage rates, and and also a period of time when rental rates were going to the moon. Well, rental rates have started to soften up now. A lot more people have actually bought homes using low rate mortgages, and so I think I think what the Sternlicht move, the Starwood move, is telling us is that there's a building imbalance between the number of available rental properties on the market, and I'm talking again nationwide. Not There's some specific areas where that's not the case. Um, and the demand for those rental properties. So, and I see this situation escalating over the next several quarters.
Okay, so you'd be expecting where this may actually drive home prices downwards a bit.
Oh, it's just like it's a upward self-fulfilling spiral on the way up. As interest rates go down, people use more and more debt to buy homes. It drives the price up. You get flippers involved, etc. And it just cascades higher. It also will tend to rip in reverse when the situation unwinds, right? So, and I think we're starting to see the housing market unwind in a pretty major way. I mean, everyone celebrates when their home builder stocks go up because they beat their quarterly number, and we've seen that this year with all the home builders. They beat their number, but guess what? Yeah, they beat a number that was lowered. It was sandbagged by management with the intent to report a headline EPS beat. But guess what? The earnings are down 30% year over year. So, the biggest culprit is probably interest rates, but there's also what people need to keep in mind is that real wages have been going down. I think I saw like 26 months in a row now, real wages, and that's we're talking about the earnings for 80-90% of all households. You're not keeping up with the rate of inflation. And so, and housing prices have proved, and again, in some areas have come down a lot. Northern California, Phoenix, some of the hottest areas are down, quite a bit percentage wise year over year in terms of home prices. But a lot of the areas around the country haven't, the prices are sticky, and rental rates have been sticky. So, when you don't have housing prices dropping to match the decline in real wages, you're going to freeze up the market. So, and that's the ratio of household income. The ratio of It's actually the ratio of the average price of a home to average household income, and this isn't even real income. This is nominal income, is like the highest it's ever been. So this situation is not going to last. It's already starting to crack, and we've been seeing it particularly in home sale volumes. And believe me, I look at the numbers every quarter. New home builders are sitting on a very large amount of inventory, both value wise and unit wise. Now, the value of their order backlog is declining rapidly. Lennar just reported last week their stock went up because they beat, but the dollar value of their backlog, their order backlog, plunged like 34%. And so that tells you that they're going to have a continued decline in deliveries and profitability going forward for the foreseeable future. So, and right now, and who knows if that housing starts number yesterday was bona fide or not. I mean, it is put together by the Census Bureau. We got to keep that in mind. My guess is the seasonal adjustments juiced the number more than it should have been juiced. But housing starts probably are up. Home builders still have access to cheap capital. They feel good about the market because they've seen interest rates come down since, really since January, maybe February. And so, yeah, I would not be surprised if housing starts increased from April. They're still down over 6% year over year. But at this point in time, when you combine multifamily units under construction and single family units under construction, the number of homes under construction at home builders is at its highest level going all the way back to 1972. And I think that's probably as far back as the data goes.
If you're enjoying this interview with Dave Kranzler and I, please consider subscribing to our YouTube channel. And if you would like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. So with the things that you're saying, I guess there's some good and some not so good there. Are you seeing? Is it possible we may enter some type of 2008 event again, or not so much, or maybe a bit worse?
I think we're going to have a replay of 2008. Only it's not going to look exactly the same. I mean, you haven't had the proliferation of 125 LTV mortgages. Liar. Although you're still there are some private pools of capital that'll let you take out a mortgage without proof of income, and so I would argue that based on the changes that were made by Fair Isaac to its credit rating system, the FICO rating system, and also the loosening up of the standards by the FHFA, which made it easier for the average home buyer to get a conforming mortgage, a Fannie Mae or Freddie Mac agency mortgage, like taking the down payment requirement from 5% to 3%, raising the debt to income ceiling from 40% to, I think at one point during and after the pandemic, I think they basically removed the debt to income ceiling, which means it didn't matter, how big your monthly interest payment is, including a mortgage that you might take down relative to your pre-tax income on a monthly basis. So the debt to income ceiling may have been put back in. If it is, it's probably at 60%. But these are lower quality mortgages than the average conforming mortgage that was underwritten during the last housing crisis, during the period leading up to the last housing crisis. So, again, I don't know if it's going to be the mortgages per se blowing up. I mean, if when you go back and you look at the default rate on mortgages back in 2008, 2009, I think the media made it sound like 30% of the mortgage holders were defaulting on their mortgages. Well, that's not true. I mean, the mortgage default rates were, I want to say, somewhere between, I don't know, 5 and 8% at most. And the misnomer was is that it was the liar loans and the 125 LTV loans that caused the blow up. Well, no, that's not technically true. It doesn't take a very high default rate, even among conforming mortgages, to blow a hole in a bank balance sheet. And a lot of these mortgages were offloaded into trusts, bond trusts, and given, you know, high credit ratings by the rating agencies. I mean, the movie The Big Short discusses this, and they outline it pretty accurately. And then you get the derivatives wrapped around these credit default swaps and interest rate swaps wrapped around these mortgage trusts that hedge funds and Wall Street firms swap back and forth. And that's really what caused the great financial crisis. I mean, the final blow up that caused the Fed to start printing money and the Treasury to cough up 800 billion to bail out the banks was when AIG defaulted on credit default swaps to Goldman, and it was, if they had just let it go, both of those companies would no longer be around. They would have blown up then.
Yeah, I remember that time. Especially the so-called liar loans. I mean, everybody was having their rich uncle stuff some money in their bank account, so when their financials were checked to buy that
Yeah,
home, everything looked a okay, and then they had to give that money back. Hopefully, gave it back to their rich
that's
uncle.
right. Well, now what new home builders are doing is, if you go and you look at a house and you say, well, I don't know that I can afford the monthly payment, and they'll say, oh, well, we'll lend you the money to buy down the rate on the mortgage for 3 years. And so it basically is a 3-year adjustable rate mortgage. So, and the argument is, well, interest rates are going to come down, so you can refi this out at a lower rate at the time. Well, what if interest rates don't come down? So, but that's what home builders are doing right now. I know a guy who out here who just bought a new home from D.R. Horton, and they put a lot of pressure on him to accept money for a buy down mortgage, and he just was like, I'm not going to do it.
Yeah, I can't imagine those people who went into those arms. They're paying a whole lot more now than they were if they took on that fixed rate.
Right. That's right. Well, the arms kind of disappeared for a while, but in the last, I don't know, 9 months to a year, they've started to come back. The 2 and 28 arms, and also these rate buy down mortgages. So, but yeah, you got a lower rate for a few years, but you still have to pay back the money that you borrowed for the buy down, and then you're taking the risk that interest rates aren't going to be higher when your mortgage rate resets in 3 years.
And then we had the Fed pausing rates. Notably, they paused rates. Are they doing this to allow markets time to recover in a higher rate environment, or is this pause a signal that we have reached or are near the highest that they can go?
I don't know. That's a really good question. I would suggest this is that the real reason why they paused isn't obvious. It's not evident, and the real reason is different from what everyone may think it is. So I think my original thinking was, oh, well, this pause is going to open the door for them to pivot because clearly the economic data, the hard economic data, is getting worse every month. And the economy is slowing down. We're just now starting to see layoffs. I mean, we've seen a big swath of layoffs at tech companies, but now we're starting to see mainstream America corporations lay off people. FedEx just warned yesterday. I mean, these companies that deliver packages, they're good representatives of the economic pulse of the country. And when their business is slow, it means that business activity in general is slow. And I just in my last short sellers journal, I discussed the demand for container board, cardboard boxes, is falling off a cliff, and it's almost as low as it is right now as it was at the bottom of the lockdown period during the pandemic period. And cardboard boxes are used to ship everything, right? And so, if there's falling demand for cardboard boxes, it means that retailers still have inventory that's way too high, and it means consumers have slowed way the heck down on what they're willing to spend money on. And it also means businesses aren't, because right, I mean, container boxes are used to deliver products at every level of the economy, from raw material producers to intermediate goods producers to end user retailers, right? So I guess my point is, circling back to this, is that I was thinking maybe the pause gives the Fed another month to let the economic numbers get even worse, and then they can justify holding rates steady and possibly pivoting into printing money in some form in the third or fourth quarter. I don't know. Probably the fourth quarter now, since I don't know, we're still at the end of the second quarter. Um, I don't know how worried they are about what happens to the U.S. dollar if they do decide to come out and make an announcement later this year that they're done with hiking rates and they're open to the idea of injecting liquidity into the banking system. I think they're going to need to. I think the regional bank crisis was just papered over temporarily, and that's going to come back. And unless the Fed has a motivated reason for letting the economic system, the financial system collapse, at some point, I really think they're going to have to crank up the printing presses again. So, so that was kind of one school of thought. It'll open the door for a pivot down the road, and maybe they are done raising rates. They say they're not done raising rates, but I mean that can change from meeting to meeting. Um, and then the other school of thought is, well, they are going to pause and wait and see what happens with the inflation numbers and economic numbers before the next meeting. But it's starting to look like inflation's kicking back up again. So I just read an article yesterday that talked about how in most areas rental rates are not what the CPI is representing. Saying that, oh, well, rental rates are coming down, and that's part of what depressed the CPI number last month. But this article said rental rates are sticky in a lot of markets. So housing equivalent rates, I should say, shelter equivalent.
So, I mean that's an interesting point because should we see rates rise again, or even if we don't, I mean, I think unemployment is in the cards, and again, people who do face unemployment, they could very well be homeowners, and then you could see a lot of homes start to get underwater, and as mentioned, a lot of corporate bought up these homes, so we could really have a trickle effect should these things continue on.
Yeah, oh, absolutely. And let's not overlook the fact that it's official now. Student loan payments are going to have to kick start up again in October, and the interest on them is going to start accruing in September. And that's gonna further depress retail spending and the ability of people with student loans who have not had to make payments, have enjoyed freedom from payments since when did the moratorium go in? Like July of 2020, I think, mid 2020. All of a sudden now they're going to, and it said the average student loan payment is 350 a month. And when you have people that are living hand to mouth, have to use revolving credit to make ends meet on a monthly basis, and then you pile in another $350 a month required payment, it's going to cause a lot of harm to the economy. And I'm not saying that they should do something to subsidize that or cancel student loans. I think that we're in this problem. We're the problem that we're facing to begin with, which seems to get worse with every crisis, is that the leniency and federal subsidies on all of this stuff has caused the problem to get worse. It was never fixed in 2008. It was just pushed below the surface, and now and it kicked back up again in 2019 when they started the repo program that was supposed to be temporary. And then, notwithstanding whatever economic damage was done by the lockdown, that 3 billion or 4 billion that the Fed injected into the system, a lot of that was to fund Treasury issuance, which the Treasury then turned into helicopter money and gave everyone their stimmies, and also to inject a lot of liquidity the banking system needed, which was evident back in September 2019 when this repo thing started.
Right. Obviously, there are quite a bit of shenanigans going on under the table that are starting to surface. You had said in 2003 that the powers that be will figure ways to sweep every crumb of middle, upper class, non elitist wealth off the table and into their own pockets before they let the entire house of cards collapse. What event or dots that you connected drew you to that conclusion back then in 2003?
Well, I mean, it's actually pretty simple, and the bailouts weren't anything new in 2008. I mean, Greenspan was the king of bailouts during the 1990s. Every financial crisis that cropped up, starting with the savings and loan crisis, which was precipitated by what they let Drexel Burnham get away with in the 80s. And the Greenspan would turn on the money spigot to monetize these problems. You had the emerging market crisis, you had Asian currency crisis, you had long-term capital, which was massive, and it was massively papered over. And so, I mean, the Fed. Well, in 2003, Greenspan started turning on the money spigot again to subsidize mortgage issuance to revive the housing market. And so, um, if you look at who benefits from the money printing, it's not the average household. It's the upper one. It's the entities that are closest to the money spigot. I think that's called the Cantillon effect. Those closest to the monetary spigot are the ones that benefit the most, and it ends up transferring wealth from the many to the few. And you can see that there's that guy Rudy Havenstein posts charts on it all the time about the wealth skew charts that are available right on the St. Louis Fred database. And so the money printing is a clever or not so clever method of extracting wealth again from the many and transferring it to the few. And every crisis along the way is used as an excuse to start printing more money, and the wealth skew gets worse and worse and worse. I think the wealth skew right now is the worst it's ever been, meaning the amount of wealth owned by the top upper 1% versus the rest. And so I was just like, you know what? They're just going to keep printing money and transferring wealth from the hoi polloi to the elitists. And when there's no more wealth to transfer, I mean, the country's being gutted right now. When there's no more wealth to transfer, that's when they'll let things collapse.
Man, we could definitely get into that and completely on its own. But with that paper creation that we're talking about, we're also sort of seeing this in the gold and silver markets, where a lot of people they do believe that within the paper markets and physical markets, uh, there is becoming less and less trust as far as perhaps true price discovery or even the existence of the metals, meaning gold and silver. What's your opinion on this?
Oh, that's a great question. I'd like to add in here. I think the amount of manipulation we're seeing now, which is really blatant, especially yesterday and today. I mean, yesterday, as soon as the COMEX opened, boom, gold was pushed down like $30, and silver was down over well, not over it. I was down about $1 at one point yesterday, and same thing today when Powell started speaking before Congress. Boom, they rip down gold and silver, and it's on the COMEX. And if you just look at an overnight chart, you can see it during Asian hours, which I call the physical trading market in the world. You'll see gold go sideways or even levitate a little higher, and then as soon as the Asian markets close and London takes control of the trading, boom, that's when you start to see the price head lower, and then it gets worse as soon as the COMEX opens. Yesterday is just a prototypical example of that process. And so I think part of what they're doing, I'm starting to think that the period that we're in right now is similar to the summer of 2008. And they took gold and silver down relentlessly between March and October that year. And they took it down because I think they knew, probably even before Bear Stearns blew up, that they were going to have to start printing money at some point. It wasn't like that plan was just hatched after Lehman and collapsed and Goldman nearly collapsed. That plan was in motion and being figured out how to implement for quite some time before that. So they pushed down the prices of gold and silver because they knew that when they announced the money printing, it was going to cause gold and silver to shoot up. And they'd rather have it. They got gold down to as low as $700 an ounce, and gold launched. Ultimately it almost tripled, right? It went up to 1900 by the middle of 2011. So they'd rather have that near tripling happening from a base of 700 than a base of, I think gold was around, don't quote me on this, I want to say it peaked around 1200 in March of 2020. So a near tripling of gold then would have taken it up to near 3000. So, it's for the purposes of optics, right? If people see the price of gold go from 700 to 1900, it's not as alarming as if they see the price of gold go from 1200 to 3000. So it's managing the signal that is provided by the rising price of gold and silver. Now, as you pointed out, I also think that there's a very tight physical market situation, especially in London, right? Because you got the bullion banks um, have to make required bullion gold bar deliveries to the big Eastern Hemisphere buyers. India, when they buy gold, I can't speak to what the government does, and they've been there. I think they just accumulated a record level of gold for official purposes, but the Indians, when they buy gold, they want it. They want it delivered, and so you can't just keep those bars in the vault and re-deliver the same bars several times over. The Indians want it, and you're also starting to see a lot of the other Eastern Hemisphere central banks, when they make gold bar purchases, they repatriate it to their home country and safekeep it themselves, and that causes tightness in the vaults. And you know, back in 2008, this wasn't happening as much. And so the bullion banks have never had to worry about it. Well, over the last, at least 3 years, because remember we had that very, very extreme tight situation in gold between the COMEX and the LBMA back in 2020. I don't know if you remember that. Um, so, back in 2008, they didn't have to deal with the demand to have bars delivered physically and removed from London vaults, like we've been seeing over the last 3 years. So, I think part of what they're doing with this price control effort that we're seeing right now is, not just to suppress the signal sent by gold and silver about, how ugly things are getting and how disastrous central bank and government fiscal policies are, but also I think they try to discourage as many LBMA forwards and COMEX futures holders as possible from taking delivery of that gold or maybe coughing up their contracts. Oh, the price is going down. I don't want this anymore. So that they're trying to minimize the amount of actual deliveries that they have to make where the bars are removed from their custody.
I think even first quarter of this year, I think Singapore is one of the leaders. I think they bought some 68 tons of gold, I believe.
Yes, and I think they're also repatriating their gold to Singapore. And oh, one more point I'll throw in there. Over the last couple months, there's a guy who consults with GATA, who I mean, he probably knows as much about what goes on at the BIS with their gold swap and gold trading activities as anyone out there. And there's only so much you can know, right? Because they're you have to go by public documents. I'm sure he has contacts, somewhere connected to the inside that whisper in his ear once in a while, but the leasing activity or the swap activities by the BIS they disappeared for a while. They almost went down to zero. In the last over the last couple months, the swap activities have escalated quite a bit. And this guy has and again, you can't outright prove it without the actual hard data from the transactions and the paperwork, which you're not going to get, but you can analyze the footprints in the snow and show and figure out where they lead. And when the BIS, when their gold swap activities with the central banks, with the Western central banks, when that starts to escalate, it's usually accompanied by a very tightness in the physical gold bar market. And so we've also seen that. And so that's another indicator that suggests that the gold bar market in London is very tight right now.
Yeah. In your opinion, do you think that there's probably quite a bit of rehypothecation going on?
It's not just my opinion. I mean, it's pretty much settled history, settled fact that the hypothecation is going on. I mean, we saw that with MF Global. The guys who were using MF Global to trade silver, and there was a large number of them who were standing for delivery when MF Global blew up, and J.P. Morgan was the custodian of the silver bars, and J.P. Morgan refused to deliver the silver to these guys. They settled in cash. And why did they refuse to deliver the silver and physical silver? Because they didn't have the bars.
Right. Right. Couple more questions. Dave, people ask me this all the time, so I'm gonna pass it on to you. If gold and silver markets are manipulated, why should I buy gold and silver?
I mean, every market is manipulated. The stock market is highly manipulated. The bond market is probably the most manipulated market in the world, right? I mean, interest rates globally, well, in most places, are artificially low because of all of the central bank sovereign bond buying and treasury bond buying. So, why not just apply that? Or why wouldn't I just hold cash? Why would I put any money to work in any of the markets? If you're going to use the logic of why should I buy gold and silver? It's manipulated, right? So the fact of the matter is, if you run the numbers between the beginning of 2001 and now, gold has been the best performer of any major asset class and most of the minor asset classes, right? So, and that's in spite of the manipulation. The only thing these guys can hope to do with manipulating the price of gold is slow down the rate of ascent, which they've done. Okay, but it still doesn't mean that over extended periods of time that you're not going to get a good rate of return on your gold. But there's a couple different ways to look at the value of your gold. You want to measure it in dollars, and that's what you're worried about. Well, then go chase Nvidia stock, right now. I mean, at some point you're going to get your ass handed to you in that stock. But if you're gold's not a rate of return investment. Gold is a wealth preservation asset, and for 5,000 years, it's proved to be the best wealth preservation asset. I've run the numbers. I mean, if you look at how many gold bars it took to buy a house in 1970, and I just use 1970 because I know what my father paid for our house. I know what it's worth now, and I know what the price of gold was back in 1970. It took something like 2.5 times more gold to buy a house in 1970 than it does right now. So that means that the value of gold is actually appreciated over that time period versus the value of your house. So, and that's a lot of people don't think about gold in that way, but how do you measure your wealth? What's your purchasing power? Well, when you have a dollar devaluating because of inflation, your purchasing power is going down unless you can generate more and more dollars, right? But the price of an ounce of gold is basically relative to what you can use it to purchase. It's and to me that tells you that it's still undervalued relative to the global monetary stock, is the fact that the price of gold keeps rising relative to the purchasing power of that ounce of gold. Okay, I mean, perfect example. Gold got bashed down to 1,200 in early March 2020, right? And now you're back at over 1,900. So I mean, run the numbers. And we're talking about gold measured in U.S. dollars. So, um, so the purchasing power of your gold has gone up 58% relative to if you just held U.S. dollars since late March 2020. So that's why you buy gold and silver, and you buy silver instead of gold. Well, silver's extraordinarily undervalued by any measurement relative to the price of gold right now. So, if you are looking for a rate of return, a positive rate of return opportunity in the precious metal sector, I mean, I think they both offer that, but silver offers more of it. And also, maybe at some point down the road, a lot of people don't want to transact in digital currencies, and there might be a whole, underground market that transacts in precious metals. And so silver offers you fungibility, but it also protects your wealth, preserves your wealth.
Dave Kranzler, before we head out, can you tell us about investment research dynamics and where people can follow you on social media?
Sure. So my blog is investmentresearchdynamics.com. I'm kind of don't post as much as I used to, but it also has links to my mining stock journal newsletter and my short sellers journal newsletter. And I'm a fairly active participant on Twitter, for better or for worse. So and I'm also on LinkedIn.
I love your tweets. So you got a really really great way of you're giving us good info, great info, factual info, and at the same time, it's it brings a bit of humor, So it's I really like how you set up your tweets. But Dave Kranzler, I want to thank you for your time, and I really hope we can do this again soon.
That sounds great, Patrick. We look forward to it.
That was Dave Kranzler sharing his views on the economy and gold. To see more of Dave's views, please visit his website, www.investmentresearchdynamics.com, or follow him on Twitter at INVRES Dynamics. If you like this video, please consider subscribing to our YouTube channel, giving us a thumbs up, and sharing with your friends. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.